Welcome to We Exchange podcast, the platform that connects women entrepreneurs in Latin America and the Caribbean with mentors and investors. In our episodes, you will hear these entrepreneurs tell us their success stories, challenges, and lessons learned venturing in the region. You will also hear international investors and ecosystem players talk about key success factors and trends in entrepreneurship. If you're interested in learning about the women entrepreneurs and the startups that are disrupting the world through innovation, or if you're interested in the entrepreneurial ecosystem in Latin America and the Caribbean, this podcast is for you. Hi, everybody. It is a pleasure to be here today with Brad Feld. For the few who don't know him, he has been a serial entrepreneur since 1987. He's a co-founder of Techstars. He's a managing partner of Foundry Group, a co-founder as well. Foundry Group has 5 venture capital funds, 1 late stage, and lately it has been investing in other funds as well. He serves on the boards of several nonprofits and is also a prolific writer. So you have so many hats, Brad, that we are trying to condense all our burning questions in a few of them, but from the different angles. So let's start with your entrepreneur hat. And I would love for you to tell us about your biggest failure and your biggest success as an entrepreneur in the companies you founded.
So my biggest failure was a company that for a period of time looked like it was also my biggest success. A company that I co-founded in 1996. It was a company called Interliant. It went public in 1999. At the peak of the internet bubble, it was worth just under $3 billion. And it went bankrupt in 2002 after the collapse of the internet bubble. It was a business where we built one of the very first application service providers. It was, pre-software as a service, but you ran hosted applications on web servers, or what we today would call in the cloud. And it had become a very large company at the peak. It was probably about 1,500 employees, $200 million a year in revenue, which at that time in that .com was quite substantial. The internet bubble collapse decimated a lot of our customers, decimated our ability to raise additional capital. We had a capital structure issue, which is we'd raised debt, a significant amount of debt as a public company, and that ultimately caused the equity value of the company to be worthless, and the company went bankrupt, and we sold out of bankruptcy. The company was cash flow positive when it went into bankruptcy. So we worked really, really hard to restructure the business to get it to work. But our capital structure prevented it from being effective because we couldn't service the debt. So that was by far my biggest failure. On the success side, I have an enormous amount of nostalgia for my first company, which was a small financial outcome on an overall basis, but was where I both learned an enormous number of things, but also developed some key relationships that transformed my life. This was a company called Feld Technologies, very creatively named after my father. We started it, a partner and I started it in 1987. We funded it with $10. We had 10 shares of stock. I had 6 of them, my partner had 3, and my dad had 1. And when we sold the company to a public company in 1993, we still had 10 shares of stock. Fortunately, they were worth a lot more than $1. And, we built a nice, smallish, it was about a 20-person business, a couple $1 million a year of revenue, but very profitable. And the public company bought us for a couple $1 million. And that was great because I was 28 at the time. The amount of money that I had was, between the profits we made from the business and then selling the business, it was more money than I expected that I have. So, that was nice. But more importantly, I ended up meeting 2 guys that were the co-chairman of the company that bought mine, Len Fassler and Jerry Pock. Because up to that point, I'd never thought about buying or selling a company. I'd never made an investment. And what happened was Jerry and Len took me under their wing. Len continues to be they're both good friends. Len continues to be one of my closest friends. He's in his mid 80s now. I learned an enormous amount about deal making from just being around them. I started making investments with the money I made from selling the company, the couple $1 million, and I made about 40 angel investments between 1994 and 96 with my own money before I started doing venture. And these were $25,000 or $50,000 investments. They were done at what today would be called the pre-seed level, and I helped start a couple of the companies. But it was quite an extraordinary experience in terms of my own learning curve and changing direction from being the founder and CEO of a bootstrap company to now being an investor in a number of companies, fast-growing ones, including some that did a bunch of acquisitions. I'll answer one last thing. In the sort of best and worst, I think the company I'm most proudest of as a founder is Techstars.
Okay.
I'm very proud of what we've done at Foundry Group, my partners and I, and that in and of itself is a startup because we started the venture firm from scratch. But in terms of the global range of impact that Techstars has had on entrepreneurship around the world, at this stage, it's probably the thing I'm most proud of.
And skipping over your investor hat for 1 minute and going into Techstars, since you mentioned it, what do you think are the factors that have contributed to its global expansion and success?
Well, a bunch of things. One is, from the very beginning, Techstars has always put the entrepreneur at the center of its focus.
Okay.
And its view is that it exists to help entrepreneurs succeed. Mm-hmm. And over time, we evolved that thinking. And today we describe Techstars as the worldwide network that helps entrepreneurs succeed. So it was always this view of building a network that covered all geography, that existed to help entrepreneurs succeed. I mean, fundamentally, I know I just repeated that, but fundamentally, I think having clarity on what that vision was and then subscribing consistently to that through all the different evolutions, I think is key. Second, David Brown and David Cohen, who lead Techstars on a day-to-day basis. David Brown is now the sole CEO, but for a while, the two of them were co-CEOs. They're two of the other founders, along with the fourth founder, Jared Polis. Mm-hmm. But David and David, are the ones that operationally run Techstars. They've always been extremely attentive to, while creating this network to help entrepreneurs succeed, mm-hmm. at the same time building an operating business that is financially successful and self-sustaining. They're in and of themselves bootstrappers. And even though Techstars has raised plenty of capital in different ways, part of what we have used that capital for, or in fact, almost all of what we've used that capital for, is not to build the operating business of Techstars, which is now 300 or so people around the world, but to invest in the companies that we're helping at the very early stages as they go through accelerators. So I think the operational focus on the business and the way that we've allocated capital has been really important to Techstars' success. And then amongst other things along the way, I think the philosophy of Techstars, which is now encapsulated in a phrase that we call give first, is key. And, that's the mantra of the organization that comes from a construct that I first talked about in my book, Startup Communities, in 2012. And the idea of give first is that you're willing to put energy into a system without knowing what you're going to get back. It's not altruism. You expect to get something back. You just don't know when or from whom, over what time period, and what consideration and what magnitude. So Techstars has operated from this frame of reference in all the different things it's done, where it's constantly trying to give first by putting energy into any aspect of the system that it can. Again, there's expected to be a commercial benefit, but we're willing to engage without necessarily having that commercial benefit defined up front. And that philosophy, which has lots of other tendrils to it, I think has been a really important one globally, as we've gone into lots of different places with lots of different cultures and lots of different, both approaches to to business and to sort of the social backdrop of how people conduct their lives. And being consistent across the entire system of Techstars has made that a lot more coherent.
Wow. So in your knowledge, because this is a topic very close to my heart, I've been building ecosystems in Latin America, and it's very challenging. First, for a long time, governments would look at all these issues as this was elitist, they didn't get what it was to be an entrepreneur. Society would not accept an entrepreneur. They would think it was somebody who was in between jobs and trying to fake it. Now we are in a very different time and situation in Latin America, but still there is a challenge of how we really make all those actors work towards a betterment and increasing the chances of the entrepreneur. So in your own knowledge of so many ecosystems, which conditions do you think are common in making an ecosystem thrive and making, the promotion and the fostering of innovation and entrepreneurship succeed?
Well, there are two intellectual constructs that I use. One that was the center of the Startup Communities book, which I call the construct is the Boulder thesis, and one which is the central tenet of the book called Startup Community Way, which will come out in mid next year. It'll come out in second quarter. That's a sequel. That's the sequel to Startup Communities. So it's not a second edition. It's actually a sequel.
Okay.
And if you think about the two, right, one was written in 2012 and the other is 2020. So we've got 8 years of learning through the experience of the Techstars and the development of startup communities and entrepreneurial ecosystems globally. The Boulder system had 4 very simple principles, which in 2012, I think were, while simple in hindsight, were mostly conceptually new at the time. The first was that the leaders of the startup community had to be entrepreneurs. Everyone else was a feeder and supported the entrepreneurs, but the entrepreneurs had to be the leader. The second was that you had to have a very long-term view. And today I describe that long-term view of a continuous long-term view. You have to be looking forward 20 years out into the future from today. So it's not that in year 15 of your entrepreneurial journey, you're looking 5 years in the future. It's that you're still looking out 20 years into the future and playing a very long-term game.
Okay.
The third is that you have to be inclusive of anyone who wants to engage in the startup community in any way. And in, the issues of diversity and inclusion around entrepreneurship were the same issues existed in 2012, but they weren't as front and center as they are today. And I don't think people were actively addressing them very well in 2012, but that notion of inclusivity was key.
Okay.
And then the last is that you have to have a continual stream of activities and events to engage people in the startup community in entrepreneurship. It's not just that you can have award ceremonies or cocktail parties or exclusive events where only certain people show up, but you have to have stuff that involves everybody and is inclusive across the whole system. So that was the Boulder thesis, and that book that I wrote in 2012, I think still holds up very, very well as a basis for how to build and evolve a startup community. The construct that we're using in Startup Community Way to evolve it is partly in response to a lot of people saying, we've been at this for 5 years, or we've been at this for 10 years, and we're making some progress, but we're struggling to get to the next level. What do we do? How do we specifically do it? And we came up with a construct that helps understand why that is such a hard question to answer. There isn't a playbook or a recipe or, just do these 9 things and your startup community or your entrepreneurial ecosystem will be vibrant and robust. And the construct we use is the idea of complex adaptive systems and complexity theory, which we shortened to make it easier to talk about to just the phrase complex systems. And the best way to explain a complex system in 2 minutes on a podcast is that there are 3 systems, 3 different types of systems. There's actually a 4th that we'll ignore. The 3 that matter are simple systems, complicated systems, and complex systems. A simple system is a thing that has one outcome. It's a recipe. If you do the following things, you'll get the answer. And so we know lots and lots of simple systems.
Yeah.
A complicated system is one that doesn't have a recipe necessarily, but has multiple paths, but generally has multiple paths to one outcome, or has multiple paths, but to a finite number of outcomes. That's a complicated system. A complex system is one that has an indeterminate number of paths to an indeterminate number of outcomes. Okay. And along the way, whatever outcomes you have, whatever your outputs are simply inputs to the continuation of the system. And the mistake that most people make, or that many people make around ecosystem development, is thinking that a startup community or an entrepreneurial ecosystem, which, by the way, those two things are different things, it is something that is a complicated system. It's not. It's a complex system that continually evolves and changes and adapts based on both the inputs and the outputs. And so many of the things that you would do to manage a complicated system, when applied to a complex system, are either ineffective or in many cases inhibit the progress or actually break fundamental aspects of what's going on. So that we built a whole book around that. So, I can't do that in the next 5 minutes and talk about it. Hopefully when the book is out, it'll be interesting and useful.
Oh yeah, I'll definitely buy it. And I have by my side the startup communities and other books. Yeah, definitely. This is really interesting. You mentioned something that is, again, very close to my heart. You mentioned the issue of inclusive, diversity, gender. So going to your investor hat, what do you think of, or better in your experience as an investor, have you noticed any differences between women entrepreneurs versus men entrepreneurs? And if so, which are those differences? Do they work towards their advantage for women or disadvantage?
The specific question is one that's a little hard for me to be clear about, because I operate from a frame of reference is that there are lots of differences amongst entrepreneurs on multiple dimensions, gender being a dimension.
Yeah.
But there are many other dimensions, and it's the combination of factors tends to be the driver of the differences, which, some of them are things that are, if you just take one gender, just take women, women have the same wide range of dimensionality on that vector. So when I categorize it male versus female, yes, there are for sure differences, but many of those differences are interwoven with other things, including experience, including education, including socioeconomic background, right? All these things that are contributors and factors to one's personality and style. If I take a step back from that, though, and I think about teams, and especially founding teams,
yes.
I believe that diverse founding teams exhibit much more creativity and much more flexibility than founding teams that are not diverse.
Okay.
And it's especially true when you start to build out a leadership team. I think that the key notion of diversity, and again, gender is a factor, but it's one of multiple factors. If you have a monoculture, almost by definition, you limit your ability to think in different perspectives and have discussions in different perspectives and then make decisions that encompass those different perspectives. And so on that direction of diversity, it's incredibly powerful, even to introduce into teams small variations, right? It's not that you have to have necessarily a team that's equal and balanced on all aspects. The other thing I'd say here is I think that the structural dynamics that create inequities in terms of diversity are very prevalent and are very inhibiting, and that especially on gender make it much harder for women to have equal footing to men in the context of entrepreneurship. and founding companies. And I think one of the things that we're hopefully, a couple of years into now, is both an understanding of those inequities and a systematic disassembling of the inequities, all up and down the spectrum, right? Not just from the perspective of founders, but also the perspective of investors, getting many, many, many more women involved as investors, recognizing that there's a long time arc associated with that. So it's not something you can fix in a year. But in addition to changing the population, recognizing that a lot of the norms that existed, in a male-dominated investor universe are not necessarily particularly effective norms. And when you introduce, or when you get many more women involved, especially in leadership roles, and you start addressing the norms and say, well, these norms over here are not helpful to the company, not helpful to people. They're exclusive, not inclusive, or they're self-limiting, or they're isolating, or they're fundamentally offensive, whatever, like put whatever negative label you want against it. I feel like we're having that conversation across, at least in the United States, across our industry much more robustly, both entrepreneurially and from an investor perspective. And it is starting to feel like there is real change building. But, as I said earlier, it's a long-term arc.
And how do you go about trying to do this when you have a fund management company? Do you have any metrics or policies to push this diversity agenda, or is basically at the relationship level, your founders, co-founders and staff think the same, and you are all looking for the same things without being prescriptive about it?
It varies. It varies by company. I mean, we have some companies that have now mandated that there be at least 2 women in the interview process for every position.
Okay.
We have others who say we want to be, on our leadership team and our board, we want to get to a place where we have gender parity, which may not be 50-50, it might be 60-40, but it could be 60-40 either direction, right? You might have five people instead of 6, so it couldn't be exactly 50-50, but that notion of gender parity. We have other people who have it as a core value of the business, but don't have any metrics associated with it. And, in some of their cases, they have it as a core value, which doesn't have a lot of substance. And in other cases, it's a core value that actually is quite substantive, even without the metrics. I think every company now is measuring on a couple of diversity metrics. In the US, I think the 2 primary ones are gender and ethnicity, top down, right? Where if there's an HR function, you're starting to keep track of it, and you're trying to increase the percentage in all of those things of non-white male in the population. Mm-hmm. But it does vary quite a bit. And I think we believe it's better to give, as an investor, it's better to give the companies lots of resources and access to resources, and for them to determine the way they do it versus mandate to them a certain way.
Sure, that makes sense. So I have two final questions or so, more or less. One would be, I know you have invested in first-time fund managers. So what advice would you give them? Do you see, like, across the board some mistakes that are common to many first fund managers? Yes. Mm-hmm.
Probably the most common ones are strategy shift, where fund manager, or a team that's starting a new fund, creates a new fund, and then very, very quickly starts chasing wherever the market is going rather than executing a strategy that they have. Mm-hmm. And I think what's really important is it's not to have a strategy that you never change, but to be really clear about what your strategy is, and then to be very deliberate about any changes that you make to it. Next is, I think a lot of new firms underinvest in their relationships with each other, but more importantly, underinvest in their own professional development.
Okay.
So I think you have to do both at the same time. It's one thing to say, we need to work together to learn how to work as a team, but then you also have to do the work on yourself. Mm-hmm. And that work on yourself comes in lots of different forms. It could be coaching, it could be therapy, it could be, your own introspective activity, it could be peer mentorship. I think that gets lost in the mix of being very, very busy, right? And not having not having time to invest in your own introspection and your own learning along the journey. And then the last is, it takes a long time to know whether you're a good investor or not.
Uh-huh.
And I think if you're a first-time fund manager, even if you've made angel investments,
Mm-hmm.
it's a different thing. And learning how to do it and being patient with it and recognizing that you might have a big early success, and that's awesome. But the vast majority of time, you're into it 5, 6, 7 years before you see a big outcome. And understanding that you're going to have a lot of things not work along the way, and knowing how to balance and manage your own emotional energy around that and the expectations in the context of your fund and whatever the communications are. I think being good at that is hard, and finding mentors and finding advisors that you really trust and that can help you with that is really powerful.
Excellent. So continuing on your investor hat, having experienced yourself the pain of the dot-com bubble and bust, and seeing recent unicorns in trouble, are you concerned today about the possible valuation bubble?
I don't think about it too much anymore for the following reason. I think that I don't know how to predict the future, and I don't anymore. So I spend no time trying to predict where things are going.
Okay.
Instead, I focus all of my energy on trying to operate rationally within the context that the companies have rather than the market environment. So, we have a lot of companies that are good-sized businesses, and the key is make sure that they have capital, make sure that they're running their businesses well, make sure that they're not doing irrational things so that they have a very fragile business, right? We started with the story of Interliant, where we had a company that was growing very, very quickly and was a big business, but had created a capital structure that was messed up. It was losing $5 million a month, and in a moment in time where the markets all of a sudden decided that they were going to reward profitability instead of growth at all costs, the company was kind of screwed. So instead of worrying about something that's abstract, like a valuation bubble, I'm more focused on making sure the companies I'm involved in are executing well and have the resources they need. At the very early stages, a unicorn valuation bubble doesn't matter at all. Right? You're just a young business. Who cares? If you don't have access to capital, then you're not going to exist. So make sure you have access to capital. Well, what provides access to capital? Make sure you're executing on the things that provide access to capital today. I try to take the problem in a different direction.
Great. So if you could go back in time, what kind of advice you would give to either your young self as entrepreneur or young self as investor?
I wouldn't give my young self entrepreneur any advice. I think the experience I had as a first-time entrepreneur early in my career was extremely formative, and obviously if I'd gone a different path, different things could have happened, but I'm very happy with that experience. The feedback I'd give to myself as a young investor, and not as an angel investor, but a venture investor in the first fund I was part of, I accidentally became part of the fund. I wasn't very deliberate about it. I just sort of defaulted into something. Mm-hmm. In a time where there was tons of stuff going on and there was a lot of activity and it was very, very busy. I would have given, the advice I would give my younger self would have been to be more deliberate about the people and the organization, both that whether you want to put the label joined or once I joined, sort of how it evolved and developed.
Okay.
I was not deliberate about it for the first 3 or 4 years. I just sort of was super busy doing deals and making investments and managing all the angel investments I had and being co-chairman of a couple of companies and just working hard. Yeah. But it wasn't focused on building a firm and all the pieces around that. And if I could go back in time, I would have said to myself, think hard about what that is, because you will have lots of ups and downs. Right now, it feels like everything's going well. When things don't go well, how do you want that to work?
That sounds like a great advice. I think we have to go. We may be coming back to you for another podcast in several months because there is so many other topics that are left due to the time. It was really great having all these insights from somebody who has seen the industry at a global stage and for so many decades.
Great. My pleasure. Thank you.
We Exchange is an initiative powered by IDB Lab, the innovation laboratory of the Inter-American Development Bank. For more information about what We Exchange does to support women entrepreneurs in STEM from Latin America and the Caribbean, visit www.weexchange.co. For more information about each episode and our guest speakers, subscribe to our podcast and follow us on social media. In Twitter, you can find us as @WeExchange, and in Facebook as We Exchange Community. Until next time.